Good day, fellow investors. I do love history. I love Ray Dalio's historic approach to current times. And now with his last two articles, I want to discuss whether he is edging closer to being right on the long-term debt cycle with the situations that he has been predicting all along. Let's start with it all comes down to the final battle. So the dominant power, the US, if they can gain control of the Hormuz Strait, they will have won. If not, then it's a sign of weakening of the dominant power. And that goes then into overextended financially, things like that, losing both military and financial control. Perhaps not now, but on the other hand, if they win there, then it will gain confidence, the dollar will strengthen, you can borrow more, etc., etc. Now, I don't think the Hormuz situation in Iran is the battle. What will be the battle in the next decade is this one. This little tiny island somewhere down there. But that is the test of true power. One power says, I'm not yet there, I'll let you spend your missiles on the other side. However, we see just the start of the skirmishes trying to weaken up the war scenario that Ray Dalio discussed many times over his long-term debt cycle. And now the current situation, kidnapping state heads, if you don't like someone you just kidnap or bomb or things like that, that sets a geopolitical precedent for the next powers, things like that. It is a war, it is fighting, it is ugly, but at the end we might like it, we might not like it, I certainly don't like it, but that's the world we are living in. Time will give us the answer, we'll see what kind of victory or not will this be, but we need to come back to the five forces, the long-term debt cycle, as all these pieces of the puzzle come together, the politics, the future taxes, because that might be the next topic that people will discuss next year is 80% of Americans are not getting richer as the richer do. So that's something that's always there, geopolitics now developing not on a good line. There is always technology, AI, productivity, job loss, nature that for the last few years has been doing okay, but you never know. In that line, always nice to read Ray Dalio's articles, but my main message is, as Dalio says here, that all markets are driven by growth, inflation, risk premiums, and discount rates. And in that line, at the current situation, nobody thinks long term. Everyone is fast growth, rebound, Iran situation solving, relief rally, things like that. And most of the money is focused on those things, fast growth and debt. And when it comes to investing, of course, the thing is that Ray Dalio needs to be right only once. We completely agree on the risks, Charlie Munger, permanent loss of capital on inadequate return. Same definitions there for Ray Dalio. And if we look at where we are now in that cycle, just look at the financial assets of total assets. Each time we were in a similar place in history over the last 100 years, it was terrible for investors. If we go to my historical chart, each time investors lost more than 60% of real purchasing power. But now we are seeing signs, we are seeing musical chair phase for the private credit, things like that, but still going, default rates, still positive, still negative. However, when it comes to investing, Ray Dalio rightly emphasizes that the key is about the real tangible wealth you can have over time. And if we look at the real bond yields, the real yields on money now, we are still deep down in negative or zero territories where it takes at best 50 years to give your money back. And even if there is some signs of positive cash flows, then the new trend comes out, the cash flows go very low, but the promises are always there. We'll discuss this more on Sunday, the two narratives. That's very interesting. 1 trillion in revenue on one hand, on the spending. We haven't yet seen the tangible profitability for all the companies. So we'll see. But as long as you can promise things are okay. The thing is that if you look at the market, Nvidia is 7% more than the US market. US market is 62% of the global market. Just one company is 4.5% of the global stock market. And when it comes to that cycle, the big debt cycle is still going big. People are just investing on price, not on fundamentals. I mean, how can pension funds make money if the real yield is zero? It's not doing anything. The key question is how to invest, how to be protected. Perhaps it will be an inflationary crash, which complicates things a lot. And when it comes to the big debt cycle, I hope, and I think Ray Dalio hopes with his whole heart too, that he's wrong. But history tells us that after all, we are still humans. Tangible wealth question, very important. At the end, it is about what you can eat, spend, things like that. The spending is to continue, the cycle, the money printing, the interest rates, without questioning profitability until that day comes. And the key question is, are you ready or not? Here we go. It's constantly developing. It is unpredictable. We have to be prepared. We have to be prudent. But then again, Buffett prudence with 370 billion in cash might not again be prudent because inflation is also there. But the thing is that Ray Dalio needs to be right just once in our investment cycle. That's perhaps the key message of what he is doing. Everything is great while stocks go up. But on the other side, if he's right just once, maybe just in 2030, maybe just in 2040, your return, your purchasing power of that real tangible things will still be very, very bad. And that is the risk we are running when it comes to investing. We live in this fast and furious world of money, of interest rates, of bombs, of this or that. Who is right? Maybe nobody's right, maybe both are right, but not just now. Yes, when it comes to investing, Ray Dalio has been wrong for 10 years now, and then people disregard him. 7 years ago, I would make a Ray Dalio video, it would be my top performing video. Now Ray Dalio, he has been wrong. And that is the timing, that's the fight between long-term investing and short-term investing. And that's the nature of the world we are living in. How to prepare if you are concerned about the long term. Jeremy Grantham says that value stocks are cheap and that 60% of value stocks outperform the market compared to 40% of growth stocks. That's interesting, and that value stocks are cheap. That might be one way of doing it. I don't think that value, just as value, might help much there because there is value just from a peer perspective and then deteriorating business, or there is real value from long-term competitive advantages no matter what happens. When it comes to strategy, scenarios, I think that we should be invested in a way that whatever happens, whomever is right, the Huangs, the Dalios, we'll discuss more of that comparing to Michael Burry and Huang's presentation. That will be interesting on Sunday. But we need to be invested in a way that whatever happens, we are okay. And that is the key question. And the answer is, I wish it would be easy that I just make a chart here, do that like Ray Dalio says, but I disagree on that heavily. That's where we disagree, not on the cycle, on the solution. Yes, it might help, especially if you did it a few years ago with gold and things like that. Tangible assets, I agree there, on the right price, on the right compounding. All what I can conclude now, and we might dig deeper into this over time, is that the next 10 to 15, 20 years might be very different than the last 15 to 20 years. I know that there will be comments where, Sven, you said practically nothing. That's exactly the message. If I say nothing, is because it's unpredictable. And then the question is, okay, we cannot know what will happen. That leads to the next question, am I okay with that? And that's something you have to answer for yourself. For now, we might dig deeper over time, over strategies, things like that. Let's put it there and then see where it goes. Thanks for watching. I'll see you in the next video.